Now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to CPA Academy. My name is Christine Lee, and I'll be your moderator for today's one-hour webinar on ERC Alert, More Than a Moratorium, presented by Rebecca Shepard and Peter Hackabo with Frost Law. We have some great information planned for you today, so let's get started. Before we kick off everything, I would like to run a quick test to make sure your technology is in working order. So if you haven't done so already, please find the questions box located on your webinar control panel and type me a message to let me know that audio and visuals are coming through and you are seeing our presenters on their webcam today. And while you're there, please let me know where you are dialing in from today across the country or across the world. And just to let you know, we'll be using this questions box as your main communication tool throughout the webinar. So you'll be using this if you have any questions or comments or you run into any technical issues, please let me know and I'll make sure to come by and help you out. All right, so let's check in on the audience today. I'm seeing Texas in here, Ohio, North Carolina, Alabama, Florida, Boston, Missouri. Welcome, welcome. Aloha from Hawaii. So good to see you all here. Thank you so much for letting me know. Now that we're all set, let's review some housekeeping information. Today's webinar qualifies for 1 CPE and 1 CE credit. And to earn full CPE today, you got to meet 2 requirements: time logged in and responses to polls. Please make sure that you stay logged in for at least 50 minutes, that's 50 minutes of our allotted time, and answer a minimum of 3 polls. If you are joining us today on a mobile device, when we do get to those polls, you might need to scroll down to find that submit button and get your vote in. And if you have to log out and log back in for any reason at all, our system will keep track of your time. We'll do our best to get your CPE credit process later today, and you should be able to see it in your accounts in approximately 24 hours. I also wanted to let you know we will be recording today's webinar. The recording will be available in your account as well as any handouts. So if you haven't done so already, you can also find a copy of the handouts available for download in the handouts section of your control panel. Now that we're all set, let me step aside and turn it over to Rebecca. Rebecca, the audience is ready and the floor is all yours.
Hi, good morning. It's morning everywhere, I believe. Thanks for joining us today. For those of you who aren't familiar with me and Peter, I'll just give you a little bit of background about who we are and why we're here today. We are tax attorneys, so I always say we're the coolest kids in the room. Most people agree. And we practice tax controversy for the bulk of our career. We both started practicing in 2011. During the pandemic, that shifted a little bit in learning that businesses were going to be shut down, our clients and small businesses weren't going to be able to function. And so we dug down deep into the CARES Act and helped everyone through every iteration of COVID relief. So PPP, EIDL, FFCRA, RRF, every alphabet soup you can think of, and eventually came to the employee retention credit once Congress decided you could use those 2 programs together. So it was like December of 2020, we started looking at the employee retention credit for our clients. The clients that were eligible, we were able to help through this process. And what happened was they were able to pay all of their tax liabilities through these refundable credits and even get some money on top of it. It wound up, changing the course of their business and able to really get them a fresh, clean start. We realized how monumental it was for our clients. We started looking outward and helping clients, throughout the country in analyzing their situation, determining whether or not they are eligible for the employee retention credit. So we started working with the National Child Care Association and the National Restaurant Association, a lot of different accounting groups, both local and nationwide, and helping people properly claim the credit, look at their clients, make a determination of whether or not they're working things through properly. And then, as you all know, the space got really crowded pretty quickly with a lot of companies that kind of just popped up out of nowhere. So like 123 ERC and whoever. That's not a real company. If there is a real company, I apologize. I believe it's made up. A lot of people just took the opportunity, whether they had an accounting background, whether they had a tax background, whether they've worked with businesses before, to enter this space. We met someone at a conference who had filed millions of dollars of claims, who told us that 2 months before he was building houses. He had no experience in tax, or really no business filing payroll tax returns for companies and giving assurances. 2 years later, those small businesses that kind of popped up out of nowhere became very, very large. And the IRS got concerned, or more concerned than they were before, and issued some press releases in how that agency is going to handle these companies. And since Peter and I have talked about ERC with CPA Academy before, we wanted to kind of give this update as far as like, what are people doing now that the IRS has come out with these releases and this moratorium on processing claims. So with that, I will kick it over to Peter.
Sure. Well, it's really interesting from what the IRS has sort of come out with over the last 2-3 years, right? It started with, hey, this is a broad-based program, was the language that they used, and we're sort of cheerleading it a little bit from the beginning. And oh boy, have those information releases changed quite a bit. And there was one from October 19th of 2022 that really set in motion, I think, or initiated the concerns from the IRS, where they cautioned people taking aggressive positions from promoters, advising taxpayers that they could be made to repay the credit, including penalties and interest. From there, IRS added ERC to the Dirty Dozen list, which is, a PR campaign, but they do it each year with the worst of the worst tax schemes and frauds to warn people. And, it was day one of the Dirty Dozen, and I think they mentioned it in 3 or 4 other days as well. So it was pretty clear that they were starting to get concerned. After October, or filing season, there was a couple more releases. September 14th, so 2 weeks ago today, they came out with information release 2023-169, where the commissioner announced there's going to be a moratorium, seemingly drawing a line in the sand between claims that were filed before September 14th and those that were filed after. So they have told us that they are going to continue to process older claims. We don't know exactly what that means, right? Like, I can prove based on a FedEx filing that something was received by the service, but hasn't yet been, reduced down to the account transcript. Is that one going to get processed? I don't know. So in the 2 weeks that have passed since this moratorium was announced, there hasn't been any additional information that's come out and exactly what that means. The IRS announced in the moratorium, in that information release, that there was approximately 600,000 previously filed returns. Again, they said that they were going to continue to process them, although they indicated that, and I don't know about these days and benchmarks, but they said that
They're lofty goals.
What's that?
They seem to be lofty goals. They said before they were processing claims in 90 days, which I never saw once.
Right. And they said you can expect dramatically slower processing times and put it at 180 days. I would say 180 days might have been the pre-moratorium, benchmark.
Best case scenario, yeah.
Yeah. I mean, so, what does this mean? I think it is a reflection that they're going to shift resources to examining refunds before issuing claims. So what they had been doing this whole time was processing these refunds by and large before examining them and then coming back behind and doing employment tax audits. So I think that that's probably likely to happen, is where they shift resources before processing. They didn't say that. The other thing is the moratorium is in place, until the earliest date that they would process new returns would be January 1st next year. It's entirely possible that the commissioner could extend the moratorium through the filing deadline, right? Like, there's no affirmative duty or statutory requirement that the service process a refund. And I think the service can, put taxpayers in a position where they would need to institute a refund claim in federal district court if they really believed, that there was eligibility, that they were rightly claiming the credit. And, part of the information release included a comment that tax practitioners have indicated anecdotally to the service that they believe that, upwards of 95% or more of these more recently filed claims are incorrect at best and fraudulent at worst. Seems like a really, really, really big number, but they have more information than we do. And if that truly is the case, then it's hard not to support what the IRS is doing in trying to tackle some of this stuff. The other interesting stuff that came out in the information release was the idea that there's going to be some sort of a voluntary disclosure program. What that looks like and how that would work, who knows? They basically punted. They said that, more information would be forthcoming this fall. We had hoped that might have happened before this, and we had heard that, maybe something would be coming out last Monday. So when we scheduled this, we were hopeful that we would be able to have some more information. From the information release, it sounds like there's going to be two parts to this program. One, in a scenario where refund checks had already been cut, some way to come back and return the money. There was at least an acknowledgement in the information release that the IRS is aware that some of these taxpayers may have paid fees to the preparers, and sometimes significant fees. I think they reference contingent fees of upwards of 25%. There seemed to be some sort of an acknowledgement in the release that maybe they were going to work with taxpayers in a situation where fees had been paid, and therefore they, by definition, couldn't full pay the refund back. Unclear though. I mean, I think it was just a comment in passing, or at least an acknowledgement of that situation. There also appears to be some sort of program or process that would be in place where they will be able to, a taxpayer, an employer would be able to say, hey, I have a claim pending. Just don't worry about it.
Withdraw your claim.
Withdraw, I think, yeah, exactly. That's the word they use. How that would work mechanically, I think, is a pretty challenging thing for the service to do, because, like I said, you've got situations where I can prove my return was received by the IRS. Somebody signed for it, but it hasn't yet made it to, account transcripts, and maybe they're doing something like that right now and focusing on just getting everything logged. This is all speculation because, again, we don't really know, but I think that maybe it's possible that you could have CI, criminal investigations, come in and put freeze codes on accounts that, somebody had indicated an interest to withdraw. I think that is going to create, if they do something like that sort of creates challenges, because, what if a claim was partially correct, or as filed it was not correct and therefore you want to withdraw it, but you do really have a case. Maybe computations were done incorrectly. Maybe someone extended eligibility too far when it really should have been an earlier date and time. That's I think the challenges that they are working through. So stay tuned about how all that stuff is going to work. The last point is, the IRS, we keep hearing from clients or prospective clients, or people who are just interested in this stuff, saying, well, I heard the program rules changed, or the rules have changed several times throughout this process. And it just simply isn't true. You've got 4 pieces of legislation that Congress passed. You've got these notices that the IRS has put out. You've got a couple of revenue procedures. You've got a couple of regulations that became final in the end of July, finally. But by and large, the noise that the IRS is making and the new stuff that they're coming out with, FAQs, or they issued a checklist contemporaneously and some additional FAQs, they're not coming back behind and clarifying the muddy stuff. They are issuing.
Which, by the way, just to interrupt really quickly, that's what we want, right? Like, that's what tax attorneys want. That's what CPAs want. None of us want to do this incorrectly. We're all trying to figure out what the right answer is. We're trying to not be overly aggressive. We're trying to not be overly conservative. We're really trying to grapple with this stuff and make sure that it's correct. And the IRS is refusing to give us anything. Go ahead, sorry.
No, I mean, roll with it. I did my thoughts on this page. I would love additional guidance. I would love clarity on what it means, what ability to provide goods and services mean. So the rest of this presentation, and maybe we pause and do a poll question here and see if there's any questions to be answered about the moratorium. But the rest of this presentation, we want to help you issue spot, knowing that there's going to be an opportunity to fix some stuff. And so, we've identified certain issues that we think are ripe for review. But I guess I'll pause there. Christine, if you want to do the poll question.
Yeah, that would be great. Thank you so much, Peter. We are launching poll question number 1. You should see that on your screens. Have you filed an ERC claim, yes or no? Let me know in the questions box if you don't see that poll popping up on your screen. It may help to refresh your browser there. And just as a friendly reminder, to receive full CPE today, you got to answer at least 3 polls and stay logged in for at least 50 minutes. And with that, Peter and Rebecca, I did receive a question here from James. He asked, the IRS has been taking the ERC and applying the credits as offsets for prior penalties. I have used Form 843, replacing the credits with first-time penalty abatements. It has been successful. What are your thoughts on this?
Yeah, absolutely. If there's a liability out there that you can argue away, that you have either reasonable cause or can get a first-time penalty abatement, then go for and do that and get this refunded to your client. That absolutely is a good way to go.
Thank you, Rebecca. And with that, I'm going to close down poll number 1 in 3, 2, and 1. And looking at the results here, it looks like more than half of the attendees are saying no, and 42% said yes. Back to you.
All right. Just before we completely shift to like our top 10, our Letterman style, issues with ERC claims, the only thing the IRS has really clarified in everything that's come out, and like Peter said, in the beginning of this program, it was this great program, it's broad-based, it can help all these people. And now it's like 95% of the claims that are filed are fraudulent and all these other things. The only additional guidance that they have issued is about banks and supply chain claims, which were fringe claims to start with. No most people weren't filing, that were tax attorneys and CPAs, tons of these supply chain or, about whether or not you're a government instrumentality claims. It's very surprising to me that a program that is generating so many checks out from the government, they've decided to not offer more help to people who are trying to get to the answer.
Sorry, I was putting slides. I thought I had supply chain handy.
I think we do in a little bit. Yeah.
So I mean, I guess the rest of this is helping to issue spot and to help your clients prepare for audit. What can you do in the meantime? Because in these audits, I mean, the IRS is going to want to get in and get out. That's the only way that they can use the resources that they have to at all effectively, audit this. So I think that you want to put your best foot forward in responding to any information document requests, any informal back and forth, because there's just so much. I mean, I think that the notice or the information release said there was 2.5 million claims that had been filed. And so again, they're going to have to get in and get out. And so if you come in with your best foot forward and you have, copies of all of the governmental orders and all of their various iterations marked up and highlighted so that they can trace, these modifications, the required modifications, through the history of the pandemic, that's going to be a really important thing. So QA 70 and Notice 2021-20 really was what the government came out with as far as, what is an employer going to need to substantiate, claiming the employee retention credit. And this came out in their very first statement, and it hasn't changed. And so they are, asking for what they said they were going to ask for. So you can't really fault them there. If the theory of the case is that there was a full or partial suspension of trade or business operations due to a governmental order limiting commerce, travel, or group meetings, you got to get the government order. You probably want to do it now because these orders are starting to come down from politicians' websites, right? A new governor comes in, they get a new website, they're not going to host all of the information from a prior governor. It's no time like the present to go and get that information. If you're talking to clients that, didn't use you to claim the credit, I think we really need to be communicating to those folks, like, go back to the person who did this, make them tell you the theory of the case and why they think this works. Make sure that they can explain for each quarter, what they're relying on. If there were declines in gross receipts, make sure you go and get the P&Ls. Do the P&Ls, make sure, the quarterly P&Ls, do they make sense? Is it reported on the correct method of accounting? If you are in a controlled group, make sure that you've considered the gross receipts for the entire controlled group. If you have concerns, go and get the bank statements, because it's going to be a whole lot easier to work through those issues now than it is later. And you want to be prepared for an audit because you're going to get an IDR and you're going to have 2 weeks to turn it around, maybe a month if you're lucky. Records of qualified wages, this hopefully is the easiest one to get, basically payroll data. Large employers, so large employers have a different definition of qualified wages. Qualified wages for large employers are only those wages paid to employees who are not providing services to the employer. So how do you prove a negative? That's challenging, right? So you're going to have to go in and show time clock or scheduling information to show that I paid someone a little bit of time when they were working, but I filled up their bucket the rest of the way while they weren't working. Documentation for health plan expenses. I mean, hopefully this comes in a work paper that somebody had prepared, where they really truly line out per quarter, per employee, what that preparer is considering to be a qualified wage for ERC versus a payroll cost for PPP purposes. They're certainly looking at that kind of stuff. And then if you're using health plan expenses to maximize the credit to get up to the $10,000 per employee, you're going to need the data behind it to show that you actually paid those expenses. Documentation of aggregate group employer determinations. So we'll talk more about this on the next couple slides, but controlled groups of corporations and affiliated service groups are definitely things that certainly the mills are missing, and not investigating who is owning these businesses and how they're owned. Are there family attribution rules and those types of things? So you ought to be prepared on that kind of stuff, because the IRS has the information to identify these things. You're not going to be able to hide from this stuff. The other thing they said is they want copies of the employment tax returns as well. Excuse me. And then we're saying, once you get this stuff, keep it for 5 years. Like we're saying they can and probably will do more examinations on the front end, but that doesn't mean they can't do them after payment as well. And if you listen to Treasury, Treasury would love to see the assessment statute extended for all of the calendar quarters. Right now, the assessment statute for 2020 is April 15th, 2024, assuming timely filing. For the first 2 quarters of 2021, it's April 15th, 2025. So relatively short periods. Now, Congress gave Treasury more time for Q3 and Q4. Those can be audited until April 15th, 2027. I think Treasury would like to see that assessment statute expiration date extended for everything. So this is what the government has said you need to have. So at a bare minimum, you need to have this stuff. I think you also, and what we're seeing in these audits is the government coming in and saying, okay, I can see your governmental orders, and I acknowledge that it at least operated on the business. Well, now I need you to quantify the more than nominal portion or the more than nominal effect analysis and show me. And that is where the rubber meets the road, and where this stuff gets really challenging, because now you're being asked to quantify, your ability to provide goods and services in the normal course. That's where these things are going to be interesting, because taxpayers are in a situation where they're then asked for data that they probably weren't tracking in real time during the pandemic, because they never knew that they possibly could be eligible for a credit like this in 2023, 2024, through no fault of their own. And so
you're also dealing with sorry to interrupt, but you're dealing with tons of different types of businesses, right? You're dealing with Joe the barber down the street, and then you're dealing with a much more sophisticated company. So it's going to be a lot harder for certain companies to be able to quantify that more than nominal effect without some assistance in kind of digging into the numbers and being able to help them go through these types of things that you can provide guidance for, especially if these people went to a third party that wasn't you, that maybe wasn't a tax professional. At this point, as this company's advisor, you can step in and help get prepared for things, so that way, if you do get asked those questions, it's not going to be a time where you don't remember the answers. And this is why I think it's a little bit unfair that the IRS hasn't issued more guidance on what does it mean to have a more than nominal effect on your ability to provide goods and services, when people truly believe that these restrictions had more than a nominal effect. They don't think, or some of them certainly don't think, they're claiming this fraudulently. They don't necessarily know what they're going to need to show to prove that they were entitled to these credits. And that could be harmful, down the road. But that's where you, as their professional and advisor, can step in.
Rebecca. And Peter, do you mind if I jump in here for poll number 2?
Nope.
No.
Thank you very much. All right, launching poll number 2. You should see that on your screen. Have you defended an ERC audit? Yes or no? Please let us know in the next 60 seconds. And while we're taking that poll, I'm going to shift through some of these questions here. I had a few people asking, what is the deadline for filing claims? Can we still submit claims for the credit at this time?
That is a very good question. Yes, there is no moratorium on filing, only on processing. And so our firm is still filing claims. We believe the claims that we file are not problematic. And we feel comfortable in our analysis and are still filing claims. The deadline for 2020 claims is April 15th of 2024. And for 2021 claims, it's April 15th of 2025. I'm not sure if we have a assessment statute slide, so if not, we'll say it at the end. But
Perfect. Thank you, Rebecca. And with that, I'm going to close down poll number 2 in 3, 2, and 1. An overwhelming majority of 95% said no and 5% said yes. Back to you.
The one thing I'll say about still filing and not filing, because I've spoken to a few clients or prospective clients who said, I want to still file. Am I getting in line? Maybe not. It's not clear if it's going to be some sort of orderly line or if continuing to mail stuff in is going to be, a pool that the IRS can go fish in later if they choose to. We don't really know. I don't think it's going to be a situation though that if you continue to file something that it's going to turn around and be rejected, because I think in that situation they would just be overwhelming appeals to deal with rejections of claims. So I think it still makes sense if you truly believe that this is an eligible employer that paid qualified wages, that it makes sense to continue to file.
we're about halfway through. Let's do our top 10 and then can try to answer some more questions.
You want to jump in? You want me to?
Sure. Yeah, supply chain claims. So we talked about this a little bit briefly beforehand. Supply chain, there is a FAQ that says if your supply chain was impacted, you had a critical good that you could not get, and therefore you weren't able to provide goods to your customers, then you can be an eligible employer. It's possible that you're an eligible employer. However, people took that very short Q&A and went like, as long as you couldn't get something, or it took longer to get something, then you can become an eligible employer. I had so many people call, Peter as well, that were like, I'm eligible, supply chain disruption. There was a lot that went into that supply chain disruption during COVID, and not all of those disruptors were because of a governmental restriction prohibiting that company's ability to provide goods due to a governmental order. So the very narrow exception for a supply chain, in our opinion, is when you are able to get your critical good from, say, one supplier. There isn't another place that you can go, and that supplier's warehouse was in New York or Chicago or someplace where there's government restrictions on the ability. So that assembly line was shut down, 6-foot social distancing or something along those lines. And therefore the company is not able to produce as many goods as they were previously. You have to really know your supply chain and understand why you couldn't get as many widgets in April of 2020 as you could in April of 2019. And it can't be because of a foreign order. It can't be because of a foreign company. It has to be a U.S. governmental order. And so it really is just a very, very narrow exception that companies, probably took advantage of during this period of time.
And it's so narrow. I mean, the GLAM, the generic legal advice memoranda, it came out and talked about supply chain, and then it identified 5 more scenarios with supply chain issues, and then knocked them all down and said this doesn't work for eligibility. And it continued to reinforce some of the stuff that was in the initial QA-12. But what's challenging and what's frustrating for us as attorneys and probably anybody in this space, they're not telling us when things do work. They're only telling us when things don't work. So, I mean, the GLAM generally was consistent with our reading, or not generally, I think it was pretty consistent. We've always imagined that you have to both essentially prove eligibility for your upstream supplier, and then also prove that, you know, there was a more than nominal effect on you as well, or more than a nominal portion was suspended. That it really is a 2-step process here, and that's really hard. And you know, I haven't had to defend a supply chain audit, but I'm not looking forward to having to do that because I think it's challenging.
And just lastly on this one, the GLAM didn't come out, you know, in 2022, going into this depth of analysis about supply chain claims. It came out 2 months ago, 3 months ago. It was very recent. And, you know, again, we're all waiting and excited and, you know, looking forward to additional guidance. But at a certain point, when you're doing it so late into the program, you know, it causes a lot of issues.
Yeah.
All right, next is you.
We doing every other? That's cool. You know, another issue is going to be qualified wage offsets. So first of all, these are, you know, revenue agents, right? That, okay, this is going to be employment tax audits as opposed to employment tax audits, and we'll talk about the implications there, but they're still auditors. They still deal with numbers. That's probably where they're going to be most comfortable to come in and, you know, say, aha, you goofed up on this computation, or you didn't do the computations correctly. So, you know, when the Relief Act came in December of 20, and they said, okay, now you can use PPP and ERC, you just can't use the same wage twice. That's a big situation where you need to make sure that you are filling up the ERC bucket appropriately without taking an inconsistent position on the PPP forgiveness stuff. So this is where the devil's in the details. Same with the Restaurant Revitalization Fund, RRF, although the way the legislation all came out, the IRS seemed to acknowledge in one of the notices that you probably could double count RRF wages in quarters 1 and quarter 2, but not in quarter 3 or quarter 4. It's a unique feature of that program. SVOG is the Shuttered Venue Operators Grant. It's another one that you know, if your taxpayer took advantage of, you've got to work through those details. WOTC, Work Opportunity Tax Credit, is another one of these pandemic things that was extended to encourage hiring from certain targeted groups. FFCRA is not on here, but that's another one that you've got to make sure that you're not double counting. R&D credits. There's quite a few. So, you know, the way we do it is we have an organizer to make sure that we're thinking through everything about, you know, did this client have this going on in 2020 or 2021 when they may have been paying qualified wages for purposes of ERC. So this is just, you know, a cautionary tale to make sure that you know everything that was going on with this client. This is all laid on top of existing IRS code and sections and programs and credits and all this stuff.
All right, we're gonna need to move a lot faster. Sorry, we should have done a 90-minute. My apologies. If we don't get to your questions, we will try to answer them, you know, within
It took me a month after after the last one, but I did answer all the questions.
We will try to do better than that. Okay, analysis of multi-jurisdictional operations. So in Notice 2021-20, the IRS discusses businesses that operate in different jurisdictions. That is Q&A 20 and 21. And what the IRS is saying is if you operate the same trade or business, even if you operate in different places and you don't consistently apply the restrictions across all of your restaurants or all of your businesses, all of your one trade or business, then you can take the restriction for that longer period. So for example, if you have 5 restaurants, 3 in California and 2 in Florida, your California restaurants were restricted through June of 2021. Your Florida restaurants were only restricted till September of 2020. One day I'm going to do a trivia game with all of the dates because I just happen to know a lot of them and I think I'm going to do well. You can take that California jurisdiction, that governmental order that restricted your business operations, and apply it to your Florida restaurants. And the IRS has blessed this. There is some confusion about what is a single trader business. What if I have one control group and I have 3 restaurants and a taco stand? That's just a taco stand and it's not a sit-down restaurant. Is that the same trader business? What if I have 3 sit-down restaurants, a taco stand, and I sell t-shirts for the restaurants? Is that the same trader business? At some point, where do you draw the line and how do you do it? And there's different court cases and how they come out. They're from a long time ago. You know, again, like if the IRS had given us more guidance, we would have a better understanding of these issues, but they'll be litigated and we'll know it eventually. We just don't know all the answers now, but these are the things to kind of keep in mind when you're making these decisions on how to file. And if you get an audit, understand what rules to push back on if the government is saying like you can only take that Florida restaurant through September of 2020.
Christine, is now a good time to do another poll?
You read my mind. All right, we are launching poll question number 3. That should be showing up on your screens now, if not in just a few seconds here. Do you agree with the IRS's decision to input a moratorium to help combat fraud? Yes or no? And I know we're running out of time, so I'll look and see if there's maybe one question we could answer here. So Carmen was asking, I work with the company ERC specialist. How different are you from them?
Peter, you want to take that one?
I am not familiar exactly with their process, so I really couldn't comment. Certainly nowhere near as large as the ERC specialist. Happy to talk offline about our process, but that's probably a longer conversation. Feel free to reach out.
Perfect, thank you. And with that, we're going to close down poll 3 in 3, 2, and 1. And we have majority saying yes, 78%, and 22% said no. Back to you.
So I'll just try to go quickly through these next 2. These are very complicated issues and really, I think, exemplifies the idea that this is interacting with existing tax law. So controlled groups are under Section 52, 1563. Affiliated service groups are under Section 414. They are in place. They're sort of anti-abuse provisions to make sure that someone can't structure these things, these businesses, in a certain way to increase credits, avoid issues with qualified plans, basically advantage ownership as opposed to lower paid employees. So basically they're referencing these things and they're saying, well, principles similar to these controlled groups and affiliated service groups should apply in this case. The takeaway here is you need to know who owns these businesses and what their relationships are and what the relationships between the businesses are. The big one that I think people are missing is a brother-sister controlled group, which involves a 2-part test. One is a controlling interest test, where 5 or fewer individuals own at least 80% of voting power, shares, whatever the metric is. There's also an effective control test where those same 5 or fewer members, in considering their ownership across the various entities, together own more than 50% of the metric that you're using, the shares, the voting power, whatever it is. Those situations create controlled groups, and they need to be considered a single employer for many purposes of the credit. Now, the really challenging thing is you have attribution rules related to family members, spouses and minor children, but not minor children under 18, under 21 for purposes of this, are going to be automatically attributed ownership in the fellow spouse or their children and parents. There's exception, at least for spouses, and so you could have a situation where, you know, one spouse owns a law firm, the other spouse owns a retail store, but they don't participate. There's no direct ownership. There's no, not a lot of passive income here, and then there's some rules about certain restrictions related to minor children. So you could have them be able to disaggregate. The problem is what if they have a minor child? Well, now that minor child is going to be considered owning both of those businesses completely. And so you create these controlled groups, and this is a very real thing, where, sort of you wouldn't imagine that. There's also aggregation possible across parents, grandparents, and adult children, but only in a situation where someone owns more than 50%. These notes at the bottom: legal adoption matters. Relationship established solely by marriage, so step and in-laws don't matter here, but we'll see on the next slide they actually do when you're doing qualified wage analysis to wages paid to family members of majority owners and deemed owners. So the next bullet point is where I'll stop on this. Be aware that the interest from more than one individual can be attributed at one time. So you could have a situation where mom only owns 30%, but that's attributed to dad, who also owns 30%. So now dad's treated as owning 60%, which is more than 50. So now I'm grabbing an adult child over the age of 21 and grabbing his 30%. Well, now dad is owned as treating 90, and now I really need to know what else dad owns. So that's where this stuff gets really tricky, and you've got to work through that kind of stuff. The next slide is family attribution rules related to qualified wages and deemed owners and the like. So, there has been some controversy here, or at least some tax professionals take issue with the IRS's analysis, but Congress referenced Section 51A1, I think is the site that is the work opportunity tax credit, and said rules similar to that are going to apply here. And well, that's grabbing Section 267 and 151 related to family relationships and deductions, dependents. And that is creating situations where people who are not owners but are related to an owner can be considered deemed owners, and therefore you need to back out their qualified wages. You may not agree with the analysis, but in my opinion, it's reasonable. Congress did this by referencing this code section. So just be aware, not only do you need to know who owns the businesses, but you also need to be aware who is working in the businesses and what their relationship is to the
All right, 1049. Q3 2021 claims based on full or partial suspension analysis. Unless the business operated in like the U.S. Virgin Islands or Guam, it's going to be very hard to find Q3 2021 restrictions. In healthcare, in some places, the restrictions went through September of 2021. But if you are a restaurant or childcare, hairdresser, most of Q3 2021 was pretty open and not restricted. A lot of people claimed Q3 2021. Number one, that has a greater audit statute, which Peter talked about. But I think if I were an auditor, that would also be companies that I would choose to look at a little closer. I would pull all the Q3 returns and see what was going on there, because you know, the IRS has no idea why you're making these claims. They don't know if it's a revenue decline or if it's suspension of operations due to governmental order. So it can raise some flags by having these Q3 2021 claims.
Yep. The next one, full-time employee count analysis. This goes back to the large employer, small employer distinction, and whether or not qualified wages includes all wages paid or only those wages paid to someone who's not providing services to the employer. The concern is that you've got some large employers out there who didn't take the time to go back and do their employee count for 2019. Are they a large employer? Are they a small employer?
Incomplete more than nominal effect analysis. Peter and I did an entire presentation on this that you can check out if you guys want to. It's an hour talking about nominal portion versus nominal effect. It's a true delight. Essentially, you know, the gross receipt analysis test is black and white. It can't be challenged. Assuming the numbers are right underneath it, you're good to go. The next test is this nominal portion analysis, where you're looking back into 2019. It is an easier test to look at because you're looking at hard numbers. My indoor dining was 32% of my total revenue in Q2 of 2019. Nominal effect analysis takes into consideration how the restrictions had more than a nominal effect on your ability to provide goods and services. That is way squishier than looking back at numbers that already exist and looking at gross receipt numbers. You're going to have something, some metric, some KPI that's going to show how these restrictions affected your business. You can't just be like, COVID impacted my business. It made it harder. You need to show how your revenue ties in. Did you add a new business line? Did you add a new location? Did it take 7 minutes to make a hamburger versus 4 minutes to make a hamburger, or make a widget, or whatever you need to do? You need to figure out some way to show that those restrictions had more than a nominal effect. It's really hard.
So real quick, these next two, just keep in mind you're dealing with employment tax auditors. They're going to also audit things that they're well-versed in and trained on. So if there are worker classification issues, basically are you treating someone as an employee versus an independent contractor, I think an employer should expect to be audited on that. Additionally, to the extent an owner is required to pay themselves a reasonable compensation, for example, in an S corporation, I think you could anticipate an auditor doing that as well. And then lastly, just the amended income tax returns. Section 280 Cap C-A says, you know, if you get a credit based on wages paid, you lose the deduction for those wages up to the amount of the credit. The regs under that code section are very clear that a specific tracing is required to the wages that generated the credit. So for those folks who are out there saying, well, I'll just pick it up in income, you know, in 2023 or 2024 when I receive the credit, that's going to be problematic. You need to go back and amend your business income tax returns for 2020 and or 2021.
Amended income tax returns, an application of rule similar to rule of section 280CA.
I just did that. I just did
it.
Yeah.
Well, you took you took my answer. Well, there's a question about taking the expense off, and does that create exposure for accountants? Because, like, are you blessing the employee retention credit claim by creating more income when this could get clawed back? I think this raises a question that accountants should really be thoughtful of. There is a lot of stuff happening that is like fast and loose with this employee retention credit stuff. And you want to be very mindful of that. You don't want to be a party to that, obviously, but you also don't want to go the other way either. I've had people call me and they're like, I'm eligible. My accountant told me not to file because it's not worth the headache. That could be problematic. for an accountant to be giving advice for somebody to not get $1 million that they're eligible for, or, you know, $100,000 that they're eligible for, or whatever. I think what, at least this is my opinion. We don't have a slide, so Peter can chime in also. I would say accountants should issue a letter to their clients that have claimed the employee retention credit and say, we have not looked at this employee retention credit claim. You're asking us to reduce our wage expense by this amount of money. Therefore, we're reducing the wage expense. We're not, if you'd like a second opinion on the employee retention credit, we suggest that you go get one. I would also suggest, if you've told somebody that they're ineligible for the credit or they're only eligible through Q3 of 2020, to send another letter that says, hey, our opinion is that you're here. We suggest that you get a second opinion. We don't tell people that they're ineligible for the credit. We say we are comfortable claiming the employee retention credit through X date of eligibility. If you want to continue, that's fine. If you would like to get a second opinion, please feel free. Or we aren't comfortable claiming the employee retention credit for your business. We encourage you to get a second opinion. We don't want to give advice where there could be so much construed, and it could go the other way in litigation in 2 years because the IRS was unclear or because we were unclear. And I think that is the best way to protect you on all fronts. I use my hands while I'm talking. Peter, do you have anything you want to chime in on that piece of it?
No, I mean, I think when you're being asked to amend returns, I think that you definitely need to make sure that there's nothing ridiculous out there. Like, you know, your client has 5 employees, but they very clearly filed, you know, as if they had 50, right? I think in that situation, no, you need to run for the hills and not be involved in amending that return. But I don't think that, you know, the accountants are necessarily auditing these ERC claims themselves. But it'll be interesting to see what OPR does in this situation. So, I mean, I certainly would encourage you to seek counsel and to work through, you know, Circular 230 and, you know, any other industry regulations that may apply to you. They've made this challenging for tax professionals, for sure.
For everyone, yeah.
Hey, Peter and Rebecca, do you mind if I jump in here and launch that last polling question?
No.
All
Please.
right. That should be showing up on your screen now. Is Def Leppard considered a great hair band? Please let us know in the next 60 seconds.
You didn't.
I did. I want to know what people's thoughts are. So there's a question about whether or not they're really a hairband or not. So I guess I could have done all the questions on Def Leppard and we could have made a decision about, first, are they a hairband? Second, are they a gray hairband?
I'm seeing the results rolling in here now, Rebecca. I'm seeing majority voting yes so far.
Well, I feel like that's almost a given, but good to know. I'm glad we're in the majority.
All right, thank you everybody for voting. Remember to get that CPE, you got to answer at least 3 polls today. I'm going to start closing down this last polling question in 3, 2, and 1. Back to you.
So with that, I always close by saying, you know, Peter and I have spent thousands of hours, sadly, working on all of this stuff, wrestling with it, trying to come to the right answers. The next day, coming back to it, going back for it again. People in our firm that don't do this work don't care to talk to us anymore because this is what we talk about and get into disagreements about, and they are no longer interested. If you have questions on this stuff in whatever way, please don't hesitate to give us a call, shoot us an email. You're not wasting our time. We're actually happy to talk about it. And it's an area of the law that is going to go away. We don't know when, but it's not going to be around forever. So while it's around, we're happy to talk about it. I always say that we are basically like Def Leppard in 1987, where we will never be as cool as we are right now, because this is just what's going on, what the topics are. You know, how often do we get to be doing something that's in the Wall Street Journal multiple times in a month? So please feel free to reach out. Let us know if there's something we can do. We will work on answering these questions that we haven't answered yet. And we hope to hear from you.
All right, fantastic. Well, thank you, Rebecca and Peter, for a great presentation. Really appreciate having both of you with us today and sharing your expertise. And thank you to our members for your participation. I'll make sure that all of your wonderful questions and comments from today will be forwarded over to our presenters once the webinar is over. We'll do our best to get your CPE credit process later today. You should be able to see it in your CPA Academy accounts in approximately 24 hours. You can also find the evaluation link for this webinar in your accounts as well as your email inbox. Please take a few minutes to fill it out and let us know how your experience was today. Check out our calendar for more webinars at cpaacademy.org, and we hope to see you on another webinar. Have a great day, everyone.
Thank you.
Thanks.